Teladoc Health falling about 4% in early morning trading on Thursday in response to reporting the company's fourth quarter results. Those results contain an important investing lesson for all investors, whether you own shares or not. Here's everything you need to know about this company's quarter and that investing lesson in about 10 minutes. My name is Brian Feroldi. As of the time of this recording, I do not own shares of Teladoc Health, which is about a $4.7 billion company. And thank you to YCharts for sponsoring today's video. Revenue for the quarter grew 15% to $638 million, exceeding Wall Street's estimate and management's own guidance. Earnings per share on an adjusted basis were negative 30 cents, worse than Wall Street was expecting, although within management's own guidance range. Margins for the period were very mixed. Gross margin, 68.6%, a very positive result here. Gross margin was a bright spot for the company. Operating margin and net margin on a GAAP basis were horrific. The lesson we will teach is about those numbers, but you can see massive drops off there. Free cash flow dropped to just $12 million for the quarter, but it was positive, showing the vast difference between free cash flow and net income for this period. Net income was negative $3.8 billion. The balance sheet remains in poor shape with about $600 million more in debt than cash. Now, margins were the bright spot for the company here, growing to 68.6% on a GAAP basis, even higher on a non-GAAP basis. So from a margin perspective, gross margin, that is the good news. Taking a closer look at the company's income statement, revenue grew 15% as we saw. However, advertising and marketing expenses grew 29%, showing the company's spending here is becoming less and less effective over time. That is not good news. The big bombshell from the period was a $3.8 billion goodwill impairment charge, which caused loss from operation to be $3.8 billion. On a per-share basis, that was a $23.50 loss. As a reminder, this is a $29 stock. So in a 90-day period, they essentially lost on a net income basis about the same amount as their current stock price is trading. On a dilution basis, dilution appears to be under control. Share count growing just about 1%, 1% year over year. So that would be a little bit of a bright spot. Digging into the numbers a lot closely, the U.S. integrated care numbers continued to grow, adding about 6 million members for the year. That was actually not that bad of a result. BetterHelp remains a very strong bright spot for the company. BetterHelp grew 29% revenue year over year on the fourth quarter basis and is delivering on the profitability target. So BetterHelp appears to be a bright spot for this business. On a revenue per U.S. integrated care member, that actually declined about 2% year over year. That's not good news because the story here is very much slower member growth, but higher revenue per member. So we want to see that come in turn positive. On a chronic care basis, this is the company's Livongo purchase. The number of enrollment continues to move higher year over year. As you can see, over the last couple of quarters, it's been choppy to say the least. On the call with investors, management said that they expect this year to be the year of increased efficiency moving forwards, and they're going to have some tough decisions regarding layoffs and restructuring moving forward. No surprise there, given what this company has done. Turning to guidance for the next quarter, management is expecting about 9% revenue growth, continued losses on the bottom line, worse than last year adjusted EBITDA, and integrated member care growth of just about 6.7%. So 9% revenue growth is expected at the midpoint. Wall Street was expecting 14% revenue growth, one reason why shares are down today. And on an earnings per share basis, management expecting about 50 cent loss, worse than Wall Street was hoping for. For the full year up ahead, management is expecting about 9% revenue growth, continued losses on the bottom line, and just 1 to 3% integrated care member growth. So they really expect to almost lose members in the back half of the year. That's not good news. So 8% revenue growth is worse than Wall Street was expecting. Earnings per share worse than Wall Street was expecting, and this is despite the year of it being efficiency. The midpoint of the guidance is right about what Wall Street was expecting, but the revenue growth is definitely worse. What should investors watch moving forward? Several things. We would say keep your eye on the chronic care business. BetterHelp, this is the bright spot for the business. Average revenue per user is definitely something to watch. That's become the thesis moving forward. And fourth, free cash flow. From a moat direction, we think the moat here is stable at best, perhaps declining under attack at worst, and the thesis here remains highly questionable. So what is the important lesson for investors to take away from this report and this year really? It is be skeptical of acquisitions. Be skeptical of all acquisitions. As a reminder, about 2.5 years ago, Teladoc announced it was going to be acquiring Livongo for a $37 billion deal, paying $18.5 billion to buy Livongo. This was the talk of the town. That deal added about $14.5 billion to Teladoc's house balance sheet and goodwill. That is a massive, massive number. As we've seen over the course of this year, they wrote down $3.8 billion this quarter and $13.4 billion of the deal this year. That is massive destruction of value. The company took an $84 loss in earnings per share this year. And again, this is a $29 stock. And we see that the goodwill has been written down from $14.5 billion to just $1 billion as of the end of the year. The good news here is that number probably doesn't have any lower to go, but essentially they have admitted that the Teladoc and Livongo merger has been a complete and utter failure. Now, the important thing to know here is that this is nothing new. If you look at studies, especially one by Harvard Business Review about the success rate of M&As, if you look back, the M&A failure rate is about 70 to 90%. So the vast majority of merger and acquisition deals fail to realize the targets. Why is this happening? The executives of the companies tend to dramatically over expect their odds of success, and that causes them to overpay for the deal. So they basically say, yes, other deals tend to fail, but we're going to do it the right way. This is very, very common. So what can investors do when they see this information? This is a big reason why on my investing checklist that I have, when I think about the risk section, the gauntlet section, I have a whole category here for growing by acquisition. I subtract points when a company is growing by acquisition. I don't like it because I know the odds are stacked against the companies. If you're interested in getting a copy of my checklist, I have a link in the show notes, and just click this free button to get a copy of it for free. Turning to how this company scores on our investing checklist, the answer there is poor, continues to be in the why bother category for both of us. Thinking through the company's valuation. Where is it on this updated business growth cycle curve? Well, on a revenue perspective, the company is here. The revenue growth has slowed so much that it should be in the operating leverage or perhaps even in the capital return phase. However, the profitability of this business is way back here. So they are nowhere close to getting to where they need to be. Hence why this is going to be the year of quote unquote efficiency, and management is focused on moving their profitability to be closer to where they should be on the growth curve given their revenue growth rate. Thinking about the company's income statement, what is optimized right now? Pretty much revenue and gross profit. Everything else is not optimized, with the sole exception being the shares outstanding on a trailing basis. And moving forward, don't expect much change to that over the next 12 months. So how to value this business on a trailing and forward basis, I think the only metrics we can use are the price to sales ratio and the price to gross profit ratio. We'll take a peek at the price to free cash flow ratio, although this is not optimized at all. And we're going to do so using the sponsor of today's video's tool, YCharts, which is an incredibly powerful tool that we use every day. If you're interested in getting a free trial of this software and 20% off, just mention my name at checkout. So let's go over and take a look. Let's start with the price to sales ratio. This number got up to 26 in the 2020s and is currently down to just 2. So trading at just 2 times sales. Let's take a look at the market cap. The market cap was $4 billion at the peak, currently just $4.7 billion. Compare that to gross profit. Gross profit here is $1.6 billion on a trailing basis. So this company is trading at 3 times gross profit. That is a very low number, and Wall Street's way of saying we don't expect that gross profit to turn into profitability in the future. Now, the PE ratio on a trailing and forward basis are utterly useless. We don't have those numbers, but we can look at price to free cash flow ratio. It's currently about 73 times, perhaps a little higher. given the big drop off in free cash flow this year. This number is not optimized, and you would hope that by 2024, all of a sudden the PE ratio and the price to free cash flow ratio do become more meaningful. Now, I don't mean to pick on Teladoc Health too much, but it's such a great case study for investors to look at the dangers of investing in a company that grow by acquisition. It's very common for those acquisitions to not pay off. Now, the good news is the goodwill write-downs should essentially not exist moving forward, and there is reason for hope for this business, especially with that BetterHelp business continuing to tick higher. But this is a company that is in turnaround mode. It is going to be focused on profitability moving forward, and there could be a thesis for this company. However, I continue to want nothing to do with owning this business, but it is a great business to study from an investment perspective. Hope you found this review to be useful. If you want a copy of my investing checklist, just click the link in the video description below. See you in 90 days on this one. Brian, out.